Welcome back to the Amateurology channel. So, for today's deep dive, I want to start with a story about the spring of 1720.
Oh, I think I know where this is going.
Yeah, you probably do.
Yeah.
So we're talking about Sir Isaac Newton, literally one of the most brilliant scientific minds in human history.
Right, the guy who codified the laws of motion.
Exactly. Calculus, gravity, you name it. So Newton invests a relatively modest sum in the South Sea Company. The stock doubles, he sells it, and he walks away with this massive 100% profit.
Which is a huge win. You'd think he'd just stop there.
Right. But he doesn't, because the market just keeps going up and up, and all his friends are getting just unfathomably rich.
FOMO is a powerful thing, even in the 1700s.
Oh, totally.
Yeah.
So he gets completely swept up in the euphoria of the crowd, and Newton jumps back in. But he buys back in at the absolute peak.
Ouch.
Yeah. Shortly after that, the bubble bursts violently, and this absolute genius, the man who mathematically mapped the entire universe, loses almost his entire life savings.
It's just wild.
He actually muttered afterward, and this is a famous quote, "I can calculate the motion of heavenly bodies, but not the madness of people."
Which is just the ultimate cautionary tale, right?
It really is.
Because we have this assumption that high intelligence or advanced degrees or even just immense computing power translates directly to market dominance.
Like, if you're smart, you'll make money.
Exactly. But if the smartest man of the 18th century couldn't outsmart the market, I mean, it forces us to confront a really uncomfortable reality about what investing actually is.
Which is exactly our mission for you today on this deep dive. We are taking the philosophy contained within Howard Marks' renowned book, The Most Important Thing, and we're just pulling it completely apart.
And just to be clear, we are not doing a boring chapter-by-chapter summary here.
No, absolutely not. We're extracting the big ideas, right? We're connecting the dots to build a unified, cohesive investing philosophy that you can actually use in the real world.
Because the baseline premise we have to accept right from the jump, courtesy of Isaac Newton, is that investing is inherently not a hard science.
Right. It's an art.
Yeah, it has to be. I mean, if it were just a neat mathematical formula, the institutions with the most capital and the fastest supercomputers would just vacuum up all the money.
They just win every time.
Exactly. But the market environment isn't, it's not a physics laboratory. Like in physics, gravity doesn't change its behavior just because you're observing it, you know?
Right, and apple falls the same way every time.
Exactly. But in the financial markets, the environment is constantly being altered by the people participating in it.
Because everyone is reacting to everyone else.
Yeah. The rules that work perfectly today actually change the underlying environment, which basically guarantees that those exact same rules will completely fail tomorrow.
Wow. So the system itself learns and adapts.
It does. It's this messy ecosystem driven entirely by unpredictable human psychology.
Okay, let's unpack this.
Yeah.
If we accept that it's this psychological art form, then the standard playbook that everyone uses, like reading the financial news, looking at PE ratios, just buying good companies, that's basically a recipe for getting slaughtered.
Oh, completely. Because everyone is looking at that exact same data.
Right. So you need a different approach. And Marx introduces this through something he calls second-level thinking.
Yeah, and the difference between first-level and second-level thinking is just staggering once you see it.
Break that down for us. What does first-level thinking look like?
So first-level thinking is simplistic. It's reactionary. It's superficial. It's honestly what like 90% of market participants do every day.
Just reacting to headlines.
Exactly. It sounds perfectly logical on the surface. Someone will say, hey, this company just announced record earnings. Let's buy the stock.
Or inflation's going up. We need to sell.
Right. It relies on this incredibly basic, linear cause and effect assumption.
Which feels safe, you know, because it's what everyone else on TV is saying.
But in an environment where literally everyone has access to that exact same first-level data, it doesn't give you any edge.
So how does a second-level thinker operate then? I'm picturing it kind of like a high-stakes poker game.
Oh, that's a really good way to look at it. How so?
Well, like a novice poker player is just staring super hard at their own cards. Right? They're just trying to figure out if their pair of jacks is a good hand.
Yeah, they're entirely self-focused.
Right. But a professional poker player barely even cares about their own hand. They're looking at the betting patterns of the entire table to figure out what the other players believe they have.
That is exactly the framework. The second-level thinker doesn't just analyze the asset, they analyze the consensus of the crowd.
They're playing the players, not the cards.
Yes. So the second-level thinker looks at that same news and says, okay, yes, this company has record earnings, but absolutely everyone anticipated these record earnings.
It's already known.
Right. So the euphoria is already completely baked into the current stock price. Therefore, the stock is actually fully priced, and any tiny disappointment in the future is going to crash it. So I actually need to sell.
Wow. It's kind of deeply convoluted when you really think about it.
It is. You have to ask these complex questions like, what does the consensus think? How does my independent expectation differ from that consensus?
And how much of that is already in the price?
Exactly. That's the most crucial part.
Okay, I see the logic, but I have to push back here on behalf of the listener. Because we're operating in an era of like algorithmic trading and high-frequency firms doing massive institutional data scraping.
The machines are everywhere. Yeah.
Right. And there's this thing called the efficient market hypothesis, the EMH, which basically argues that millions of highly motivated, rational participants are processing all available information instantly.
That's the Chicago school theory, yes.
So under EMH, the price of a stock at any given millisecond is exactly what it's fundamentally worth. If the market is essentially a supercomputer perfectly pricing everything based on all known data, how can a second-level thinker ever actually find a wedge to exploit?
That is the big question.
Right.
And we really need to dissect that efficient market hypothesis carefully, because it actually gets one thing profoundly right and one thing disastrously wrong.
Okay, what does it get right?
It gets the speed right. The EMH argues that because of all those highly motivated participants, new information is reflected fully and immediately in the market price. And I agree with that. Markets are ruthlessly efficient at speedily incorporating data.
Like within fractions of a second.
Exactly. But here is the fatal flaw. The EMH assumes that the consensus view evaluating that data is always objective and accurate. Speed of pricing does not equal accuracy of value.
Because the algorithm might trade in a microsecond,
Yeah.
but it's ultimately trading based on human sentiment, right? Or at least trading against human panic.
Exactly. Let's look at the Yahoo example that Marx highlights. Back in January 2000, right at the peak of the dot-com mania, Yahoo was priced at $237 a share.
That is so high.
Right. The market rapidly processed the euphoria. But then in April 2001, just over a year later, that exact same stock was priced at $11 a share.
Wait, from 237 down to 11 in 15 months.
Yes. So you have to ask yourself, did the fundamental mathematical reality of Yahoo's long-term cash flow generation really decline by 95% in a little over a year?
I mean, no, of course not.
Right. The efficient market simply couldn't have been right both times. The consensus rapidly priced in infinite optimism, and then it rapidly priced in apocalyptic pessimism.
So it's perfectly efficient at being totally wrong.
Exactly. It's highly efficient at being wrong.
That completely reframes the whole EMH for me. It basically means the market's mistakes are massive, but they're psychological mistakes, not informational ones.
Yes. Which actually sets up a really brilliant 2x2 matrix for how you have to behave if you want to win.
Oh, I love a good matrix. Walk us through it.
Okay, so picture a grid. The horizontal axis is your behavior, conventional versus unconventional. And the vertical axis is your outcome, favorable versus unfavorable.
Okay, got it in my head.
So if your behavior is conventional, meaning you think and invest exactly like the consensus, you are mathematically guaranteed to get conventional results.
Meaning you just mirror the market.
Right. If the market has a good year, you have a good year. If the market tanks, you tank.
You're just a leaf floating on the river. You just go where the current goes. Precisely. You literally cannot achieve above-average market-beating results with conventional behavior. It's logically impossible to beat the crowd if you are the crowd.
Right. The math just doesn't work.
So to outperform, your behavior must be unconventional. You have to dare to diverge from the consensus.
But I'm guessing that's where the danger comes in.
Oh, big time. That's the terrifying part of the matrix. If you are unconventional and you are wrong, you get severely below average results.
So you don't just lose money, you look incredibly foolish while doing it.
Exactly. Because if you fail conventionally, you can just shrug and say, well, the whole market was down, what could I do? You have the comfort of company.
Right. You can blame the economy. Everyone else lost money too, so you don't look stupid.
But if you fail unconventionally, you are totally alone on an island. The only way to occupy that winning quadrant, the unconventional behavior leading to a favorable outcome, is if your judgments are actually objectively superior to the crowd's.
But how do you ensure your judgment is actually superior? Because you can't just be a contrarian for the sake of being a contrarian.
No, absolutely not.
You could just look at a booming tech company and say, well, everyone loves this, so I'm going to short it, just to be edgy and different. Contrarianism without some kind of anchor is just gambling.
It's extremely dangerous gambling.
Right. So what is the objective gravity? What does a second-level thinker use to pull themselves away from the madness of the crowd?
The anchor is a relentless, almost obsessive focus on something called intrinsic value.
Intrinsic value. Okay, let's define that.
To a pure value investor, an asset isn't just a squiggly line on a chart or a ticker symbol on a screen. It is a fractional ownership in a living, breathing business.
Right, there are actual factories and employees behind it.
Exactly. And that business has a concrete intrinsic value that can be calculated. You look at its present, tangible cash flows, its hard assets, its brand equity, its capital structure.
So you're finding out what it's truly worth today.
Yes. Value investing is about determining what the asset is fundamentally worth today, completely independent of whatever the market sentiment is doing. And you only buy it when the market price is significantly lower than that intrinsic value.
Okay, we should probably contrast that with the other dominant styles out there just to make the distinction really clear for you listening. Because value isn't the only way people do this.
No, it's definitely not.
For example, growth investing. That's entirely focused on the future, right?
Yeah, growth investors might look at a company with zero current profits and say, the intrinsic value today is completely irrelevant because in 10 years, they are going to own the entire market.
They're betting on a trajectory.
Which inherently involves far more guesswork. I mean, growth investors have to accurately predict technological shifts, consumer behavior changes, and macroeconomics a decade out.
That sounds exhausting and highly prone to error.
It is. Value investors prefer the bird in the hand. And then, if you go to the absolute far end of the spectrum, you have momentum investing, which just abandons fundamental analysis entirely.
That's essentially the day trading mentality, isn't it? Buying a stock simply because it's going up.
It is the greater fool theory in action. A momentum investor buys an asset at $100, not because they think it's actually worth $100, but because they are betting they can find someone foolish enough to buy it from them tomorrow at $110.
Wow. They're just trying to surf the psychology of the herd.
Exactly. It requires zero knowledge of the underlying asset. It's just a highly risky bet on human momentum.
Which, I mean, works beautifully right up until the music stops and you're the last fool holding the bag.
And we've seen that happen so many times.
Yeah, I think the clearest historical illustration of why ignoring intrinsic value is so lethal is the Nifty 50 craze. This was back in the late 1960s and early 70s.
Oh, that's the perfect example.
Walk us through the mechanics of that specific bubble, because from what I understand, it wasn't a bunch of junk internet companies. These were the best businesses on earth.
That is the most insidious part of the Nifty 50. The consensus identified 50 blue-chip dominant corporations. We're talking IBM, Xerox, Polaroid, Coca-Cola, Avon.
Like the titans of industry.
Right. And the narrative at the time was that these companies were so economically bulletproof and their growth was so historically consistent that traditional valuation metrics just didn't apply anymore.
They thought they were literally immune to gravity.
Exactly. The consensus believed that the price you paid literally did not matter. If a stock was trading at 80 or 90 times its earnings, the logic was simply just hold it long enough and the company's compounding growth will eventually justify whatever price you paid.
So they completely decoupled the quality of the company from the reality of the price.
And that is the deadliest sin in investing, because eventually the macroeconomic environment shifted. The 1970s brought huge oil shocks and massive inflation.
The environment changed.
Yes, and the pristine growth rates of these companies inevitably slowed down because no company can grow at 20% forever.
Right.
So when the growth slowed, the market abruptly realized they had paid for decades of future perfection that was never actually going to materialize.
And the bubble pops.
Violently. The multiples compressed. Companies like Polaroid and Avon saw their stock prices utterly decimated. We're talking falling 70, 80, even 90%.
Even though they were still profitable companies. Like, they didn't go bankrupt. They just stopped being perfect.
Exactly. They were still great companies, but terrible investments. It proved this immovable law of financial gravity. There is no such thing as a good asset, regardless of price.
That's a great line.
A world-class monopoly business can be a catastrophic investment if you pay too much for it. And conversely, a struggling, dying business can actually be a phenomenal investment if you buy it at a steep enough discount.
Because the price dictates the return, not just the quality of the asset.
Precise.
Okay, so let's put the listener right in the driver's seat here. Let's say you've absorbed this. You've done the deep, second-level analytical work. You calculate the intrinsic value of a really solid cash-producing business to be $80 a share.
All right.
You look at the market, and because of some temporary macroeconomic panic, everyone is selling, and the price drops to $60.
A classic value setup.
Right. So you confidently step in and buy it at 60. Does the market immediately recognize your genius and correct itself?
I mean, if only, right? But no, this introduces the profound psychological agony of value investing.
Agony is a strong word, but I feel like it fits.
It really does, because calculating intrinsic value is honestly only 10% of the battle. The other 90% is pure emotional endurance.
How so?
Well, as John Maynard Keynes famously noted, the market can remain irrational longer than you can remain solvent. You buy at 60, feeling incredibly smart. But a week later, the panic intensifies and the stock drops to 50.
Ouch.
And a month later, it's at 40.
Which is a dynamic that is entirely unique to financial markets. I mean, it's literally the only industry in the world where a massive fire sale physically drives customers out of the store.
That's a brilliant way to put it.
Like if a luxury car drops from $80,000 to $40,000, there's a line around the block. People are fighting to buy it. But in the stock market, when an asset goes on sale, the herd just screams in terror and runs away.
Because in the consumer world, the utility of the car is obvious and static. You know what a car does. But in the financial world, price action is deeply intertwined with social proof.
Explain that a bit more.
When the price of your asset drops from 60 down to 40, the market is aggressively telling you that you are wrong. It is incredibly difficult for the human brain to look at a plunging ticker and not think, uh-oh, the institutional investors must know a secret that I don't. The fundamentals must be broken.
It's like the ultimate gaslighting.
It really is. And conversely, when an asset skyrockets, we fall in love with it because the rising price validates our ego. It makes us feel smart.
So how does a value investor actually survive that drop to 40? Do you just close your eyes and hold on?
You must have an ironclad conviction in your original analysis. If you reevaluate the company and determine that the intrinsic value is still truly 80 and the drop to 40 is purely emotional market panic, you cannot just hold.
You can't.
No, you must average down. You have to aggressively buy more at 40, staring directly into the teeth of the panic.
Man, that takes some serious guts. But wait, I have a question here. Because intrinsic value isn't a magical, unchanging number etched in stone, right? Companies do suffer permanent structural damage.
Oh, definitely. Look at Kodak.
Right. Kodak was a great company until digital cameras existed, and then its intrinsic value went to literally zero.
Yeah, the fundamentals completely evaporated.
So if you're holding a falling knife, how do you mathematically and psychologically distinguish between a temporary market panic where you should buy more and an actual permanent destruction of the underlying business where you need to just cut your losses?
Yeah.
Because this tension, it feels like we are bordering on how we define risk.
We are squarely in the territory of risk now. And to understand how to navigate that exact tension, we have to completely deconstruct the way the financial industry currently defines risk. Because honestly, it is fundamentally broken.
Really? How so?
If you go to any business school today or read academic finance theory, they universally define risk as volatility.
Meaning just how much the price bounces around.
Exactly. It's the statistical measure of how much an asset's price fluctuates up and down around its average over time.
Why have academics universally settled on volatility? Like, why is that the gold standard for them?
Because academia requires mathematical elegance. To build complex financial models, to calculate things like the Sharpe ratio or the efficient frontier, professors need a hard, objective number that they can measure from historical data and just plug into a spreadsheet.
And volatility gives them that clean metric.
Yes, but it is proxy. And it is a terrible proxy for reality. Practical, real-world investors do not care about volatility.
Right, because daily fluctuations don't really matter if you're holding for a decade.
Exactly. No portfolio manager wakes up in a cold sweat, terrified that their assets might fluctuate by 3% on a Thursday. Fluctuations are just noise.
So what is the actual ground-level definition of risk then?
The only risk that truly matters is the probability of permanent capital loss.
Permanent capital loss.
Yes, it is the danger that you invest $1 today and you never, ever get that dollar back. That is what keeps real investors awake at night.
And because the academic world uses volatility as their proxy for risk, they've inadvertently created like one of those deceptive visual aids in modern finance.
Oh, you mean the risk and return graph?
Yes. Anyone who has taken an intro to economics class has seen this. It's a simple chart with a straight line angling upward from the bottom left to the top right.
Right, the classic 45-degree angle.
Exactly. And it implies, visually and mathematically, that the more risk you take on, the higher your return will be.
It is an incredibly dangerous chart because it implies a guarantee. It lulls retail investors into believing that if they want to get rich, all they have to do is find the riskiest, most volatile asset class like obscure cryptocurrencies or highly leveraged tech startups and just buy them because the universe owes them a higher return for their bravery.
But we have to forcefully correct this logic, right? Howard Marks points out this brilliant paradox about that exact graph.
He does. He says if riskier investments dependably produced higher returns, they wouldn't be risky.
Exactly. If it's mathematically guaranteed to go up more, where's the risk?
There isn't any. It makes no sense.
So how should we actually visualize that relationship between risk and return?
Instead of a straight line pointing up, you have to visualize a probability distribution. Think of a bell curve that widens out as risk increases.
Okay, making a mental picture of a bell curve.
When you take on more risk, the expected return has to be higher just to entice you to buy it, but the actual range of possible outcomes becomes massively wider.
Ah, I see.
Yes, you might hit the jackpot on the far right side of the bell curve, but the left side of the curve also stretches far out into the negative. Taking on more risk means exposing yourself to the very real probability of severe, unrecoverable losses.
I really want to ground this in a tangible example from the source material, because risk is a notoriously slippery concept to grasp. There's this analogy about a California builder that I think perfectly illustrates how invisible risk truly is.
Oh, I love that analogy. Let's break it down. So imagine two houses built side by side right on a major fault line in California.
Okay.
House A is constructed by a meticulous engineer. They use reinforced steel, flexible foundations, the strictest earthquake codes possible.
Built like a fortress.
Right. And House B is just thrown together by a cheap contractor using shoddy materials and absolutely zero structural integrity.
So on a beautiful sunny Tuesday in July, those two houses look completely identical from the street.
Exactly. If you just look at the daily price history, the volatility on a sunny day, you cannot tell which house is riskier. Risk control is totally invisible in good times.
Wow. That's profound.
The shoddy house might even look like a better investment in the short term because it costs less to build, so its short-term yield is higher. You only discover the true nature of the risk when the earthquake hits.
The earthquake being, in our world, a macroeconomic shock, like a credit freeze, a global pandemic, a sudden spike in interest rates.
Right. Loss is what happens when risk meets adversity. Marx uses a biological analogy here that is great. He says germs cause illness, but germs themselves are not illness.
Right, they're just the potential.
Exactly. Illness is the visible symptom that results when germs successfully bypass your immune system. Risk is the unseen potential for loss. Capital destruction is the illness that appears when the environment turns hostile.
Which means you really can't judge an investor's skill purely by their returns during a raging bull market. They might just be living in the shoddy house and the earthquake just hasn't hit yet.
Precisely. Anyone can make money when the market only goes up. And this hidden nature of risk leads to arguably the most fascinating, completely counterintuitive phenomenon in all of finance: the perversity of risk.
The idea that risk is highest exactly when we feel the safest. Unpack the mechanics of how that actually happens in the market.
Yeah.
Because it sounds backwards.
It does sound backwards, but it comes down to the concept of the risk premium.
Okay, what is the risk premium?
When investors are terrified, say, during a recession or right after a market crash, they demand a massive discount to buy an asset. They essentially say, look, things look terrible out there, so I will only buy this stock if it is priced so low that I have a huge margin of safety.
Right, they want to be compensated for their fear.
That demanded discount is the risk premium.
But what happens when things are going great?
When the economy is humming, unemployment is super low, and the stock market has been going up for 5 years straight, investors get incredibly comfortable. They look at the recent past and just extrapolate it indefinitely into the future.
They think the sunny Tuesday is going to last forever.
Exactly. And because they feel safe, their risk tolerance skyrockets. They literally stop worrying about the earthquake. And because they stop worrying, they stop demanding the risk premium.
So they're willing to pay top dollar.
They bid the prices of assets up to astronomical levels. But here is the perversity. By paying those astronomical prices, they have completely stripped away any margin of error.
Oh, I see.
The widespread belief that there is no risk is exactly what drives prices to unsustainable extremes, thereby actually creating maximum danger. High confidence leads directly to high prices, and high prices guarantee low prospective returns and massive downside.
So mathematically speaking, the market is objectively the most dangerous, the teller, exactly when everyone agrees that it's completely safe.
Yes.
And conversely, when everyone is panicking, selling assets at rock-bottom prices because they think the market is terrifyingly risky,
Yes.
those dirt-cheap prices actually make the market incredibly safe and primed for massive returns.
It is entirely counterintuitive to human biology. We inherently want to run with the herd. But the mathematics of value dictate that high fear equals high safety, and high confidence equals high risk.
That is just, it's a huge mindset shift.
Yeah.
But if we know this, if this cycle of boom and bust has repeated itself for centuries, from the South Sea bubble to the dot-com crash to the 2008 housing crisis, why do we collectively keep falling into the exact same traps?
It's the million-dollar question.
Like, we aren't a species of idiots. We have history books. What is the psychological machinery that overrides our logic every single decade? This brings us to the concept of the pendulum in the herd, doesn't it?
It does. We have to understand that the market does not progress in a rational, linear upward slope. It is a pendulum.
Okay.
It swings violently between euphoria and depression, between extreme overpricing and extreme underpricing, between pure greed and pure fear. And the most vital characteristic of this pendulum, the thing you really need to internalize, is that it spends almost zero time resting at the midpoint.
The fair value point.
Right. It is almost always accelerating past fair intrinsic value toward one extreme or the other.
Walk us through the specific anatomy of one of these swings. Like, how does a bull market actually manufacture itself from scratch?
Marx outlines 3 distinct stages of a bull market cycle, and they are entirely psychological. So stage 1 occurs in the absolute depths of a bear market.
When everything feels hopeless.
Exactly. The economy is in shambles, everyone is terrified, and prices are deeply depressed. But a few forward-looking, perceptive contrarians realize that things won't be terrible forever. They see slight improvements on the horizon, and they start quietly buying these massively underpriced assets.
Okay, so the smart money moves first, then we move to stage 2.
In stage 2, the economy actually does begin to improve. The corporate earnings catch up. Most average investors finally recognize the improvement is happening, and they start buying. Prices rise to reflect fair intrinsic value.
And this is that brief moment the pendulum passes through the midpoint.
Yes, but it never, ever stops there.
Why? Why can't we just stay at fair value?
Because of the massive influx of new capital. As prices rise, it validates the narrative. And this leads to stage 3, where pure giddiness takes over. The latecomers, who have been sitting on the sidelines being cautious, watch the early investors getting incredibly wealthy.
Envy kicks in.
Massive envy. Everyone concludes that the good times are permanent, they extrapolate the recent growth to infinity, and they just buy blindly, completely, regardless of the underlying fundamentals or the price.
And I imagine a bear market is just the exact same movie played in reverse.
Precisely the same. Stage 1. A few thoughtful investors recognize that valuations have completely detached from reality and they sell. Stage 2. The fundamentals actually start to deteriorate and the broader market realizes there's a problem.
And then stage 3.
Pure panic. Everyone assumes the economy is going to zero and they liquidate everything at fire sale prices, completely ignoring the remaining intrinsic value of the assets.
I really want to dig into that stage 3 euphoria for a moment because it's so easy to judge people in hindsight.
Oh, of course.
But in the late 90s, you had brilliant engineers, doctors, and lawyers who were literally quitting their stable jobs to day trade internet stocks that had zero revenue. What is the specific emotional cocktail that causes a totally rational person to abandon all analytical rigor like that?
It's a really powerful combination of biological impulses. It begins with greed, which is just the basic, normal desire to improve one's financial standing. But greed is rapidly amplified by envy.
Right.
It is psychologically excruciating to sit on the sidelines trying to be a disciplined value investor while you watch your neighbor who you know is less intelligent than you buy a third vacation home because they are blindly throwing money at tech stocks.
The fear of missing out. FOMO isn't just a silly internet meme. It's a profound social anxiety.
Exactly. And then you add ego to the mix. When the market is going up and you are making money, your brain doesn't attribute it to a rising tide lifting all boats. It attributes it to your own personal genius. It feels intoxicating.
You think you figured out the cheat code?
Right. But the final and most dangerous ingredient is what Marx calls the willing suspension of disbelief.
Which usually manifest as the four most expensive words in the English language. It's different this time.
Yes. Investors will enthusiastically accept entirely novel, completely unproven economic theories to justify sky-high prices because they desperately want the party to continue.
So they just rewrite the rules.
In the 90s, they literally said, profits don't matter, only eyeballs matter. In the mid-2000s housing bubble, they said, real estate prices literally cannot go down on a national level. They willfully ignore hundreds of years of financial history just to justify the current extreme.
I read about these Solomon Asch psychological conformity experiments referenced in the notes, and I want to bridge that to investing. Because Asch put a subject in a room with actors, showed them lines on a board, and the actors intentionally picked the wrong line.
And the subject eventually caves and agrees with the group, even though they know it's wrong.
Right. But looking at lines on a whiteboard is super low stakes. How does that biological desire to conform override the survival instinct of not losing your entire life savings?
Because financial value is inherently social. It isn't just about agreeing on the length of a line. In the market, if everyone around you says a stock is worth $1,000 and you stubbornly insist it is only worth $10, you aren't just holding an unpopular opinion.
Right.
You are actively missing out on wealth creation in real time. The herd is getting richer and you are not. From an evolutionary standpoint, isolation from the herd literally meant death. Our brains are hardwired to equate social consensus with safety.
So going against the crowd feels like stepping out of the cave alone into the dark.
Yes. Standing alone, even when you have the mathematical reality on your side, triggers deep physical, psychological distress.
Which means being a successful contrarian requires way more than just a spreadsheet. It requires immense emotional fortitude.
Absolutely.
If the extremes of the market are created by the consensus, and at those extremes the consensus is always wrong, then your only path to outsized returns is to consistently do the opposite. You have to aggressively buy the assets that are universally despised, the orphan assets that no one wants to touch.
Yeah.
And you have to sell the exact assets that everyone loves.
And you have to be willing to look like an absolute idiot for a long time while you wait for the pendulum to swing back. That requires a very specific character trait. A deep, abiding sense of humility.
Humility.
Yes. Which transitions us to the final and perhaps most difficult piece of the puzzle. To be a true contrarian, you have to admit the limitations of your own foresight. You have to embrace the philosophy of I don't know.
This is a radical departure from everything we see in the financial media.
Yeah.
You turn on CNBC or Bloomberg, and it is just wall-to-wall pundits, portfolio managers, and economists aggressively declaring exactly what the Federal Reserve will do next month, where interest rates will be in a year, and exactly what the S&P 500 will return by Christmas.
It is an entire industry built on the illusion of certainty.
It really is.
Marx divides investors into two distinct schools, the I know school and the I don't know school. The I know school is incredibly dangerous. These investors believe that the macroeconomic future is inherently knowable and predictable.
And therefore, they make massive, concentrated bets on their specific forecasts.
Yes.
And if they happen to guess right on a massive macro shift, they become legends. They end up on the cover of magazines.
But that is where we have to introduce Nassim Nicholas Taleb's concept of alternative histories from his book, Fooled by Randomness.
Okay, how does that fit in?
The I know investors who make those huge bets and win are praised as visionaries. But Taleb argues that we are blinded by the actual outcome and we completely ignore the massive role of randomness and the alternative outcomes that easily could have happened but just didn't.
I love Taleb's Russian roulette analogy for this. It's so visceral.
It really paints the picture.
Right, like if you put one bullet in a six-shooter, spin the cylinder, put it to your head, and pull the trigger. And you hear a click and survive. Does the fact that you survived mean that playing Russian roulette was a mathematically sound decision?
Of course not.
The process was insanely risky. You just got a lucky outcome.
Exactly. The financial world constantly confuses coincidence with causality. We look at a fund manager who took a reckless, unhedged risk and happened to survive the spin of the cylinder, and we label them a genius.
Taleb calls this the lucky idiot syndrome.
Right, he does. Over a 1 year or 2 year period, it is statistically impossible to distinguish a highly skilled, risk-conscious investor from a lucky idiot who just happened to be on the right side of a random macroeconomic coin flip.
So if a manager's one-year return is essentially just statistical noise,
Right.
how do you ever evaluate if someone actually possesses skill?
Skill only reveals itself over a long horizon. You have to look across multiple full market cycles, both the bull and the bear markets. Over 10 or 20 years, the luck evens out.
The law of large numbers takes over.
Exactly. The lucky idiot eventually pulls the trigger on the chamber with the bullet, and their portfolio blows up. The skilled investor, who consistently manages risk, is the one who survives.
Which brings us back to the I don't know school. If we humbly accept that the macroeconomic future is just a probability distribution, that we cannot know for sure if inflation will spike, or if a war will break out, or if a pandemic will shut down the globe, how do we actually construct a portfolio? Like, you can't just hide cash under a mattress.
No, you can't. The I don't know investor focuses their energy on the micro, not the macro. They admit they can't predict the economy, but they can analyze the balance sheet, the cash flows, and the intrinsic value of an individual company.
So they focus on what they can actually measure.
Right. And then, because they know the macro environment is unpredictable, they construct a portfolio built for extreme resilience. They practice defensive investing.
I want to use a sports metaphor. It looks like in practice, because I think people really misunderstand the term.
I'm intrigued. Let's hear it.
In American football, you have entirely separate units. You have an offensive squad filled with quarterbacks and wide receivers whose only job is to score. If they turn the ball over, the whistle blows, they run off the field, and a completely different squad of giant linebackers, the defense comes on to stop the bleeding.
That's right.
But investing is absolutely not American football.
How so?
Investing is like soccer. In soccer, the exact same 11 players are on the pitch for the entire 90 minutes. They have to play fluidly in both directions. They have to push the ball forward to score goals. But the millisecond the opposing team intercepts the ball, those exact same players have to violently pivot and scramble back to protect their own net.
Oh, that's a great analogy.
In the market, you do not get a whistle. You do not get a timeout to swap out your aggressive tech stocks for safe treasury bonds the second a market crash begins. Your portfolio must be constructed with players that can score points during the good times while constantly inherently protecting the goal against sudden disaster.
That is a phenomenal way to visualize it. And the mechanism for protecting the goal in investing is the cornerstone of value investing, the margin of safety.
Break down the margin of safety for us.
If you do the math and determine a company is intrinsically worth $100, you do not buy it for $100, because if your math is slightly wrong, or if a totally random, unpredictable macroeconomic shock hits the system, you will immediately lose money.
So what do you do?
Instead, you demand a wide margin of safety. You refuse to buy it unless the market offers it to you at, say, $60.
So that $40 discount is basically your shock absorber.
Exactly. If your analysis was too optimistic, or if a recession hits and the company's earnings drop, that discount absorbs the blow. You might not make a massive profit, but you preserve your capital. You don't lose the game.
It's all about defense.
Defensive investing is about patient opportunism. You do not aggressively hunt for deals in an overpriced market, driving prices up. You sit patiently. You hold cash.
You wait for the pendulum to swing.
You wait for it to swing to the extreme of terror, and you let the investments come to you when distressed sellers are forced to liquidate at irrational, panic-induced prices.
It's prioritizing survival over maximum yield.
As the old trading floor motto goes, if we avoid the losers, the winners will take care of themselves.
That's powerful.
This game is not about hitting grand slams. It is about batting average and avoiding strikeouts. You do not need to make a 300% return in a raging bull market if you can successfully ensure you never suffer a 50% drawdown in a bear market.
Because climbing out of a 50% hole requires a 100% return just to get back to zero.
Exactly. The mathematics of compounding massively favor the investor who simply avoids giant, unrecoverable holes.
Wow. We have covered a tremendous expanse of conceptual ground today, from the mechanics of intrinsic value to the psychology of the herd. Let's pull all of these disparate threads together into a single, cohesive tapestry.
Let's do it.
I want to speak directly to you, the listener, as we synthesize everything we've uncovered today. If there is one profound mindset shift you need to walk away with after this deep dive, it is this. Superior investing is not a game of prophecy.
No, it's not.
It is not about possessing a crystal ball, discovering a magical algorithmic formula, or having a faster fiber optic cable than the institution next door. Superior investing is ultimately an exercise in emotional discipline and structural asymmetry.
Beautifully said.
It requires the deep second-level thinking to calculate what an asset is truly worth when the rest of the world is just staring at the price tag. It requires the contrarian courage to aggressively step into the arena when the herd is screaming in terror, and the immense restraint to sit on your hands when the crowd is celebrating.
That's the hardest part.
And above all, it requires the profound humility to accept that the future is heavily dictated by randomness, meaning your primary job is not to predict the earthquake, but to build a portfolio so structurally sound that it doesn't matter when the ground starts shaking.
If you can internalize that framework, if you can separate the mathematical reality of value from the psychological hysteria of price, you won't just survive the violent pendulum swings of the market, you will thrive on the irrational mistakes of those who don't.
Which leaves us with a final, somewhat unsettling thought for you to explore on your own. Everything we discussed today hinges on the premise that the market is, at its core, a pendulum of human emotion. A constant rhythmic swing between fear and greed, amplified by envy and ego.
Right, it's built on human nature.
But what happens to the pendulum as we accelerate into a new era? An era where autonomous algorithmic trading and artificial intelligence are executing the vast majority of trades, analyzing data in microseconds without a single drop of human adrenaline.
That is the great unknown.
Will these unfeeling, hyper-rational machines eventually dampen the swing of the pendulum, removing emotion from the equation entirely, and finally creating the perfectly efficient market the academics always dreamed of? Or will these models simply learn to map and prey upon our psychological blind spots? Will AI anticipate human panic and euphoria so accurately that it actually front-runs our emotions, making the next bubble swing higher, faster, and crack with a violence we've never seen before?
Whether the machine cures the madness of crowds or weaponizes it is honestly the defining financial question of our generation.
Something to think about the next time you log in to check your portfolio and wonder who or what is on the other side of your trade. Thank you for joining us for another deep dive on Amateurology. Keep questioning the consensus, stay skeptical of the crowd, and we'll see you next time.